Hello and welcome to the Trade the Trend. My name is James Boyd. We welcome all of you here today. And one thing I want to do just real quick is welcome all of you. If you're a frequent attender, we welcome you. We got Lena, Betsy, Dragon Rider 108, Kevin, Dom, Thea, and many others. We also have Brent Morris in the chat. We welcome him as well. Quick reminder, this session is being recorded, okay? And Brent, if you wouldn't mind, send out your X information, your handle. And also remember that we'll actually go to this Schwab calendar where we can see other classes that we actually hold throughout the week. Brent will actually teach advanced options tomorrow. Check that out, and I'll show that in just a moment. Now, when we talk about trading the trend, we're really talking about really looking at 2 to 3 weeks to 2 to 3 months. At the shortest, it's really 2 to 3 days to 2 to 3 weeks. Really looking for something 2 to 3 weeks, 2 to 3 months, where there is some series of higher highs and higher lows over time, okay? Now, in this class, we don't really focus on one or two sectors. We're just really trying to identify where are those trends, okay? Now, remember, when we talk about examples here today, they will be stocks and options. If we talk about options, remember that options carry a high level of risk and are not suitable for all investors. We will do stock trades, so don't think it's all going to be options. Remember that the information here is provided for general informational purposes only, should not be considered an individualized recommendation, okay, or endorsement of any particular security, chart pattern, or investment strategy. Also remember, when we talk about investing involves risk, including loss of principal. Our examples would be done on the paper money software, okay, for educational purposes only. Now, also when we talk about short options like selling calls, selling puts, remember we're talking about American style options, so where those could be assigned. If you did a covered call, you deliver the shares at the strike price. You sold the put, you buy the shares at the strike price. That can happen prior to expiration, regardless of the in-the-money amount. So you have to realize that is a potential risk. Some of you might say, well, that might be an opportunity. That's up for you to decide. And also when we talk about options, remember the option Greeks, which measures a sensitivity to something. Now, today, boy, this will be fun to hear today. Lots of questions. Okay? And by the way, I think it's a nice way to kind of go back and review some of the things we've talked about and how they're playing out. Now, we'll talk about some of the technical analysis we're seeing on the indexes and also maybe some of the other commodities. We'll talk about identifying these trends. I want to isolate on the higher highs, but specifically higher lows, okay? We'll talk about kind of the trends in the multiple time frames. I want to get into that. And I really want to kind of talk about like allocation a little bit and position sizing, okay? So we're going to wrap that into this. Now, first off, let's go back to our chart just real quick, or our grid here. And this is what we always like to kind of do, is just kind of bring this up, okay? So first off, we're not going to look at the chart yet. Let's kind of look at the table here. VIX down to 22. Hallelujah. Okay, sorry, just had to let it out. Yeah, okay. Okay, fine, let's move on. Now, if the VIX is down, okay, you got the SPX, NASDAQ, Russell, and the Dow. Dow is about 1.52. Now, the small caps leading here today, 2.47%. Now, usually when people are thinking about is the market bullish or bearish, if the Russell is leading on a percentage basis, it's usually viewed as kind of an indicator of investors are willing to take risk. Remember, it always goes back to that grid that I showed before. If people are willing to buy those assets, or we'll call them sectors, if they're buying technology, if they're buying discretionary, if they're buying financials, if they're buying energy, and let's say materials, M for financials, IXM, IXY, the industrials, IXT, the technology, IXE, the energy, IXM, the materials. If they're buying those sectors out there, those are areas that tend to be more growth oriented. In the middle there that we drew before was industrials. We would also include with that transports. Boy, do we have something to talk about on industrials today. And if you take a look at this, U for utilities, V for healthcare, R for staples, and RE for real estate. So if we go look at the market and it looks like everyone in their, well, some people might say everyone and their mom and dad, cousin, brother, aunt, uncle, grandma, grandpa, and even their pets are buying those top right areas, well, there's kind of some risk-taking behavior, okay? Now, So the thing is, does that mean that those are guaranteed to go up? No, it just kind of shows some of the sentiment. Now, here's the deal. Your sentiment can be different than the market sentiment, okay? So what the investors are trying to really do is align themselves or trade to kind of what trends are in the current marketplace. Never forget that diagram, okay? Now, some of the things that stand out major, semiconductors up 2.34%, the Japanese yen getting hammer smashed. Is that a bad thing? No. Remember, we call the Japanese yen the international VIX, okay? So not a bad thing to see that dropping. And we also see the US dollar putting some green on the back, again, of that face of the dollar bill, up 1%. And you're going to see gold actually down 84, which is kind of good and bad, okay? Maybe some of the fear coming off a little bit. And the Swiss franc, okay, coming down 1.25. Now, by the way, the Japanese yen and the Swiss franc, that's not a small drop. You drop 1% or go up 1% on the currency, that's massive, okay? So what we're seeing here today is fears coming off, okay? Now, someone else's fear might not be coming off, but from the market, we're seeing some of that fear coming off. Sectors, just briefly. When you take a look at sectors, and this was kind of one of the comments is the participation. Think about the grid that we just drew, okay? And remember, if we're trying to really see our investors willing to take risks, we know technology, discretionaries, energy, materials will include some of the financials, okay? Now, if we look at the tippy top, we got, and this is ranked how? Well, it's ranked by how do we want to rank it? Let's rank by percent change. What we see right now is industrials leading. Now, I'm telling you, I want to know what sectors are you watching? If some of you are watching industrials, what stocks are you watching? Give them to old JB. Let me know. I won't tell anyone. It's just me and the dog. Okay? So now there's base materials. There's energy. There's discretionaries. There's tech. There's materials. Now, per the diagram that we already drew, without looking at this, the only one that's slipping in there that's higher than the higher beta one. So when I say higher beta, what does that mean? That means historically, on a percentage basis, they've moved more than the S&P. They have a higher volatility relative to the S&P 500, okay? Now, they also kind of have maybe potentially higher volatility to the S&P 500. Yeah, but what about the utilities, staples, healthcare, and so on? Well, they tend to underperform. Healthcare is still down. Utilities up a little bit. It's just not up like the high beta ones are, okay? So if I say like low beta, we're just saying stocks that typically on a percentage basis don't tend to move as much as the S&P 500. And they probably also pay a dividend, okay? They're not as much growth, okay? Now you're gonna see that also there's real estate, there's staples. Communications we did not mention. We would probably wrap in their communications with technology / discretionary. Now, if someone said, hey, we got a higher high here today, is this really gonna hold? Well, kind of see further confirmation. Well, the biggest thing is we're kind of getting the fear to come off. That's one. Is that a bad sign? Many investors might say, I don't think it is. The other part is, are we getting the sectors to participate which are more growth oriented? And the answer is, so far we are. Now here's what happens. Okay, even with that, yeah, but I want confirmation. Look, the bottom line is you're just willing to take risk and seeing if the trend plays itself out. Okay. Now, what I want to do is let's show these charts just real quick. Now, here's the thing. If I was a listener, I would like a teacher that was consistent in terms of methodology and every day is not a different idea. That would worry me if every day was a different idea, okay? Because there are such things as principles that are timeless, practices which are timely, okay? But what are some of the principles? Well, principles, we're going to talk about looking at the trend, right? And that 61%, which we talked about ad nauseum, we got above that, and we have held above that, okay? Now, what you're now going to notice is we got to the 71%, even though the investors didn't believe it, okay? You're going to see that we got above the 71%, and so far, we went down. And on Friday, we talked about seeing the higher lows. We talked about lower shadows. Don't say we didn't talk about that. We talked about that, right? And we gave you practice and a homework assignment in seeing those higher lows. we saw lots of tails there last week on the intraday lows. And then today, what we also talked about on Friday is seeing what we call close higher gap on the chart. Okay. So far, we're seeing a bounce. The 61 held. The 78% held. If we hold the support level, the path of least resistance, it could potentially go up to here. Now, let me speak to this for just a sec. I heard someone on TV today talking about, well, these tariffs, yeah, we got the one with Great Britain, but these other ones, it might take 2 to 3 months before we know for sure. Look, duh, okay, duh. Investing, if a farmer doesn't plant a seed of corn and the next day it's 6 feet tall, okay? So what the investors try to do is investing is about really where it is today and where they think it's going to go tomorrow, okay? And so the thing is, they're trying to invest and have the expectation be realized over time. If the investor waits until the corn is 6 feet tall, the investor's fear kind of misses the opportunity. And that's what happens a lot of the time. So the reason why I say this is I think some investors, it sounds good what people say, but it's about as odd. Why do investors buy cyclical stocks in recessions when the earnings are suppressed? Okay, when the revenue is down, it's because they think in the next coming weeks to quarters, etc., they're going to rebound. Okay, and there's a discount between where the price is and where they think it could go. And some investors, they just don't get that. Okay, now, I've tried my hardest. I'm going to continue to try. Okay, but I think sometimes there's more technicians that are speaking to fear than actually understanding of fundamentals and how investing really works. Okay, if someone is going to wait until everything is, and by the way, there's always something pending out there, always. But if someone waits until everything is perfectly clear, usually that investing potential opportunity to buy at a potential discount, that window is significantly closed. Okay, now we could kind of think about like buying a house. When do you get the best deal on a house? Well, it's not when the economy is booming. Okay, it's when there's some fear, job losses, things like that, consumer confidence low, retail sales low, right? High interest rates, things and so on. It's bad to push the prices down. So you have to kind of learn, how do I take advantage of fear that pushes prices down? Because investing is usually about the opposite of how you feel. Okay. Now, the oddest thing as we kind of shift here is how many technicians turn into economists when the market falls. It's the oddest thing ever. Okay, that's my rant. Okay, but it deserves to be stated because I think a lot of investors, there's been a lot of stuff that might not be helpful. Okay, it's probably more hurtful than helpful. Okay, now if we look at the Dow, tell me what you see. Well, take a look at what we see. You kind of see that's a higher high. Now, what you're now going to notice is if I took this trend line, which we've had, I didn't make it up today. This is the one we've been watching. We've been talking about ascending triangles going to the upside. We're seeing if over time, can it hold the diagonal support, the horizontal support? So far it has. Okay. And if the price stays above that line, currently there's momentum and there's a trend. We don't know what's going to bring tomorrow. Don't know where it's going to bring in the next 2 weeks. But so far it's staying above the trend line. And the investors that have experience, they're trying to buy the stocks that are above the moving averages and staying above support. And they're seeing if over time, if they could potentially trend. That's what it is. Okay. Now, Dow, what you're going to notice is the Russell has pulled this up. Russell did make also a short-term high. We don't talk about the Russell a lot, but there it is. And the NASDAQ, yours truly. Now, the NASDAQ, if there was maybe a little taste of fear out there and people are really concerned, okay, it might be a little awkward to actually see the NASDAQ being the first index that has done the 100% rip right back to the upside. Now, you kind of take a look at this. I mean, it is surprising. If there's so much fear, okay, why is NASDAQ actually leading to the upside? We'll also bring this point, which we said the other day. If there's a recession coming, Why is financials ripping as much as it is? That's very unusual, okay? If you really think there's going to be a recession and it's going to be long, okay? And by the way, I want to kind of state this. You can have pockets of recessions in the U.S., but the U.S. is not in recession, okay? And that's always been the case. That doesn't change. So true. And there could be industry groups, sectors that are in recessions while the other ones on a majority are not, okay? So financials bring up industrials, okay? I don't know about you, but that looks like the size of a 2x4, okay? An 8-foot long board to the upside. I don't know what they call that candle, okay? We're just going to name it a 2x4 to the bears, okay? And if we also take a look at the, let's say the last one, second to last one, discretionary is trying to really make a higher low, lagging some of the other areas. And if we also looked at the $ IXC, the communications, that has also been one to kind of get a little scored as well. Now, it's not to say that when you look at utilities, they're bad. They're just not up as high as percentage. We're not saying the consumer staples are bad. But what you're now going to notice is they're not getting that percentage push that those growth areas do. And that's why some people like those. Now, when we talk about these things of what I said on the chart, we're just expressing where they are right now and where they've been. Like with technical analysis, the investor's buying today, thinking what it could do tomorrow, the next day, and so on. And the fundamentalist is actually buying the stock, thinking that the fundamentals are going to continue over time. But they don't know the future, whether a technician or a fundamentalist, they don't know, okay? And that's why they call it investing. We don't know tomorrow, okay? That's why they position size and set a stop and try to maybe change the strategy. Now, if we take a look at this, I want to kind of bring up a couple stocks that have maybe stood out a little bit. Now, if I said to you industrials, and I said, what stocks in the industrial space are getting a little push here today? Now, a lot of people sometimes struggle with a watch list. I'm going to ask you not to struggle with a watch list, okay? And so if someone said to me, James, I struggle with the watch list, I'm going to go to Market Watch, going to go to Visualize. And if someone said, James, what might be a sample, like a smaller list, because having more stocks to look at might not necessarily be helpful. Let's say that the whole stock market was the S&P 100, hypothetically, okay? And we said, hey, we saw the industrials doing quite strong, and we have a little group of stocks right here that are on the S&P 100. So we can kind of get a little gist of which the color green, the darker the color of the green, the stronger the trend, and so on, okay? And what you're now going to notice is if I click on that, you're now going to see that if we take a look at this, go to, let's say, industrials, okay, right there, it just magnifies what we really saw, okay? And actually, I misspoke. The lighter, sorry, I was reading a comment. The lighter the color of the box, the stronger the percent change upside if it's green. 4.28% on Deere. If we look at darker green, it's not as strong, okay? 0.73 for Honeywell. Now, I want to go back to one of them that's actually been, so this now becomes an immediate list, okay? Now, in our examples, we do not look at probably stocks lower than $20. We definitely don't look at stocks below 5, okay? We're looking for companies that are proven. They're battleships, okay? They've been around for a while. They have market share. They've maybe bought companies over time and made their company bigger. They have earnings per share. There's a greater likelihood that they can weather economic storms, okay? Now, there's a point to what I just said, and I'm going to hit it in just a second. We're going to go back to Boeing for just a second. You tell me what you see on this chart. Now, sometimes investors might say, yeah, but before we couldn't get above resistance. Well, you got to remember, if the fundamentals were poor before, does that mean it's going to be that way in the future? Well, no. And second, if we're talking about technicals, just because historically there has been a resistance at 186, does that mean there's always going to be a resistance at 186? No, just say no. So here's the thing. One of the things we've been kind of talking about as of late is we've been mentioning how many stocks kind of really made these higher highs going into resistance, and how many of these stocks were making some higher low plateaus into the resistance. Now, this is a very interesting topic because why on earth would someone be buying stocks up near highs? Why? Why would they be buying up near highs? Why would all of a sudden the stock gap up into the resistance and then intraday push, intraday push, intraday push, and someone could say a comment like, oh, wow, it's resistance. Now, remember what we talked about. When people keep pointing out resistance and then disrespect the fact that we're making higher lows, it really doesn't give a complete technical analysis assessment. If the price is making higher lows underneath the resistance, the probability that the resistance could be pierced, poked through, broken out, whatever you want to call it, becomes higher and higher. Because if we make higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, if we make higher lows into the areas of resistance, just like if I took a hammer and was beating a cement wall, if I keep beating that wall over and over and over, and all of a sudden I start chipping away some cement and then eventually poking through it. It's the same thing with technical analysis, okay? Now, what might drive that? Could be fundamentals, sure. Could have been that fundamentals over time are horrible and they're starting to improve. It could be technically that we're starting to improve, just like we just talked about. Now, what I want to do here is I want to show an example of this, okay? Now, by the way, let's look at this on a weekly, 3-year weekly chart. And if we look at this on a 3-year weekly chart, this is what other people are going to say, okay? So when I say other people, sometimes technicians will say comments like, well, you know, yeah, but I like to see it get above 198. Well, wait, you just completely disregarded the 189. And these prior highs here and here, it's not that these are not prior highs, but these become trading ranges. So it's a true comment that someone says, hey, 198 could be resistance. That's true. But if we break the old resistance, the path of least resistance is to go to the next level. You break the 198, you can stay above the 198. The path of least resistance is to go to the 218. And we've gone over this and over this and over this. We're just seeing it happen again and again and again. Now, here's the deal. If we take a look at this, let's say the investor says, okay, these now become targets to the upside. Okay? They become targets to the upside. Now, if we had a bearish trader out there, they might say, James, if we get above 189, I want to get out of the position, cover the short, and then you might get a long investor who says, look, I'm going to take a breakout trade. Okay? So you could have both sides, you could have both things happening. Bearish investors exiting because they're probably losing a lot, potentially, and bullish investors say, oh, look, brand new high, brand new breakout. Okay? So now if you take a look at this, now James L says volume profile for BA. Now I'm just going to tell you, I don't look at volume, okay? I don't look at volume. I know you might be surprised. I've said that before, okay? I don't look at volume. The reason why, so a lot of times now, if we pulled up volume, if volume, for example, showed that we were 89% of the average, wonderful. We just try to, for example, look at, let's say, stocks that already have an average volume over time. They're listed on the indexes where they're probably going to have the potential for future volume. We don't know. It could change. But we look at the stocks and the indexes because they already have volume. Now, here's the nice thing. As a technician, you do not have to use every other tool that everyone else wants to use. And you might have some different things you like to see. For this class, we're looking at the price. Okay? Now, sometimes what can happen is people will say comments like, well, the volume is less than average. Does that mean a stock can't make a brand new high? If someone becomes a millionaire or has 10 million plus, isn't that statistically abnormal? But could it still happen? Right? So the moral of the story is sometimes you don't always have to necessarily get the price to make a new high with volume. If you had volume on the back of what the price is doing, think of that as just icing on the cake. Little sprinkles. Now, I don't know if it changes the breakout trade, okay? Think of it as just more potential confirmation. Now, what I'm going to do in this case is we're going to go to this. We're going to go to, let's start with a stock position first off, okay? Now, when we started with the stock position, I want to go back to the example when we talked about yesterday of position sizing, okay? And what I want to do is I want to kind of take the bigger dollar account that we're kind of working off. That bigger dollar account is at 100,522, okay? So 100,522, okay? Now, this is not a new concept here. We've talked about, for example, could the investor be willing to risk a 0.5%? Could they be willing to risk 0.75%? Could the investor or would the investor be willing to risk 1% of the portfolio value at that point in time? Now, if we looked at the stock price and said, okay, what's the stock price? Where do we see potential support? Some investors might say, James, I kind of see that support, that recent pullback area right around 184.66. So I'm going to put that support level, just using this as a sheet of paper, 184.66. And what I'm going to do in this case is, what's the current stock price right now? Current stock price sitting here right now, 193.48. All right. Now, just like we always talk about, right? If the stock is greater than 50 bucks, in our examples in the paper money account, we're going to look to set a stop below support or the higher low area, less 2%. It's going to give us 180.97. Now, notice the language we always use, the forecasted risk per share. The reason why we say that is because if we set the stop, that does not guarantee it's going to get exactly hit at that level. The loss could be worse. Now, if we said, hey, James, if we were investing, let's say, in a $100,000 portfolio in this example, wonder if the investor, let's say, wanted to invest 5% capital in a stock position. Well, they might have up to maybe, perhaps, or theoretically 20 positions if each one was 5%. Is everyone going to be perfectly at 5%? No. That's why you might have a round, okay? If they did 8% of the portfolio value each, theoretically, you might have around 12 positions, okay, if you did stocks. If we did 10% of the capital of the portfolio, well, theoretically, you'd have 10 positions if each one was at 10. Now, why is that theoretically? Because we're making an assumption that all the positions are stock positions. And that's not maybe true. It could be stocks and options. So think of this in terms of maybe the number of stock positions, okay, around. Now, if we said, James, I'm willing to risk, let's say, a 0.5%, okay? And if we said, hey, I'm willing to, let's say, double check. If I did 0.5%, you're now going to see that if we bought, let's say, a 5% position of the portfolio, 5% of the capital, or 5,000 bucks, it's going to give us 26 shares of stock. And the forecasted risk per share, okay, is really going to be 325. So in other words, if we bought, let's say, 26 shares of stock, and the forecasted risk from entry down to the stop was $12 per share, the potential loss, assuming we get stopped out right at that stop price we talked about, is 325 bucks. Now, I don't care if it's 2000, 2001, 2002, 2005, 2015, 2025. At the end of the day, the investing really comes down to risk and psychology. Okay, do you understand that? You could also say it comes down to really math and psychology. It's really what it comes down to. Okay, now, whether we take risk in 2005, 2015, 2025, 325 bucks is 325 bucks of risk. Okay, now, what we know is if the market were to go to the upside, boy, it sure would be helpful. I mean, we're not blind, okay, to the fact that, wow, it'd be nice if the market were to go up. It might help, okay, don't look at Travelers yet. It might actually help to get Boeing to go up if the overall market can go up, and also at the same time that maybe the sector could go to the upside. Exactly, couldn't agree with you more. Now, what I'm going to do is going to do 12 shares. With the stop that we actually wrote down there was 180.97, and it got dated GTC, okay? Now, we haven't set the target. If we actually looked at that upside target and said, where is that target? Well, it's 198. And this is what you want to be kind of thinking about is, does the investor really want to try to invest for only that first short-term target? Maybe not. Maybe they're thinking maybe a little higher. In our example, we're going to choose a little higher. We're going to go about 215 or so. Okay. Now we know that historically the fundamentals have been horrible. Okay. Now, when I say the word horrible, what does that even mean? Well, their earnings per share have been negative. The sales have actually been really suppressed. Now, maybe you say that's wonderful. I don't know. Usually negative numbers aren't wonderful for most people, but yeah, everyone's different, right? Got a target, got to stop, confirm, send, and now there's a position here for going long Boeing. It's a stock position. Notice the order in red there. It's already referring back to what we said. With stop orders, there's no guarantee the execution price will be equal to or near the activation price. Noted, send. Now, what we're going to see in this case is, I want to go back to something, and I want to kind of show you something. So when we look at the portfolio in the IRA, if we said, well, how many bearish positions are in the portfolio? Easy answer. 1, 2, 3, 4. Miss one? 1, 2. We got at least 3. I don't see any others. So if we looked at these 3 positions that are negative delta, and negative delta, those are the 3 bearish positions. The other ones, they're bullish. So if we have, let's say up here, let's say 18 positions, 15 are bullish, 3 are bearish. Now, could you be bullish some and bearish some others? Yes. Okay, that's possible. Okay. Now, do you have any questions? Okay. Now, what I want to do is kind of just see if there's any questions. Now, I want to kind of also just kind of see as those questions, I just asked if there's any questions. Let me give you a moment to type those in. I'm also looking at the chats as well. Let me just kind of go back to this. Now, the one thing I want to kind of go back to, just kind of bring up just real quick, where I sometimes feel that we can get emotionally, I think we can kind of emotionally go to a place that maybe is not helpful, okay? So the question that I had yesterday when JP brought up position sizing is kind of, do you have a number, a dollar amount, a percent amount of your portfolio that you're willing to risk? Question number 1, okay? And by the way, I don't care if someone said, James, I've been investing for 20 years. If someone cannot answer that first question, it doesn't matter if you've been investing for 20 years. It's a first year question, okay? So that's very important. You have a certain amount of money that you're willing to risk. Unless you're doing something like buy and hold, which is not what we're talking about, that question needs to be answered. The second question I want you to kind of be thinking about is, when we talk about investing, is that I just want to solidify is, when we have market volatility, it sometimes seems that many investors, they are 100% short term. So when I say short term, what I mean by that is 2 to 3 days, okay, days to weeks, 2 to 3 weeks, okay? So I'm going to imagine that most of us here are 40 years old and over, okay? We're probably not going to want the asset values that we have where 100% is banked what happens in the next 2 to 3 weeks. Are we on the same page here? Do you want to bank everything or a lot of your capital and your risk? What happens in the next 2 or 3 weeks? Many investors would say, have we lost our minds? Okay, good point. Now, when we actually say because who knows what happens in the next 2 or 3 weeks. Now, when we say intermediate, we're talking about 2 to 3 weeks, and I'm going to go out to maybe, let's say, 2 to 3 quarters, okay? Now, when we say quarters, this is very important because what happens in 1 quarter with a company doesn't mean that's what's going to happen in the next quarter, okay? So intermediate would be like 2 to 3 weeks to 2 to 3 quarters. And if we say long term, we're really kind of saying 2 to 3 quarters, okay? To let's say, plus. Okay, now I want you to kind of think about something. The question I want to kind of get at is, how much of your portfolio is really banked on short term? How much? Now, some investors might say, James, I have 80% intermediate in long term and 20% short term. Okay, fine. Then why do people sometimes act so emotional? I think the people that act really emotional are the people that really say, James, everything is banked. What happens in the next 2 or 3 days or 2 or 3 weeks? Be careful. Be careful. Okay? Now, wonder if the investor said, James, I'm going to do 70-30. James, I'm going to do 60-40. Or James, I'm going to do 50-50. Okay? If I take a lower percentage intermediate to longer term, it's probably because I'm a little younger and I don't have gray hair on the side of my head, on the roof of my head. Okay? Now, could someone do that? Yeah, they could. It's just you're kind of putting yourself more at risk of what happens in the short term. But if someone is going up higher percentage intermediate to longer term, higher percentage there, they're probably saying, look, I'm investing for 2-3 weeks minimum, trying to quarters, to 2-3 quarters, to years, plural, okay? And so could some of the portfolio be hit on what happens in the short term? Absolutely. But the investor who is really putting a higher and higher percent to short term, which I define what that means for this class, that's why they're so emotionally involved. What happens in the next 2-3 days? Okay? You got to remember what we said last week. Some investors are not investing for the next 2-3 days. Some investors are putting capital work today because where they think the market's going to be in the next 2-3 quarters to 2-3 years. That's what's called investing. Okay? And so much lately of what I've heard is this over focus on what's happening in the next 2-3 days. You got to understand, not everyone invests for that time period. And that you probably could say a large chunk of the money is really looking at investing, not scalping, not swing trading. Okay? And even if the investor did that, I'm not saying it's bad, but the biggest thing is how much does the investor have percentage-wise in those areas? I think that's important to really bring up because you might be doing damage to your own self, okay? Now, the one thing we kind of want to talk about here is when you take a look at, let's say, Travelers. One of the things we brought out that was pretty easy to see in terms of a theme. Now, it doesn't mean we couldn't see beyond the future that it was going to go up. We said, geez, there's been a little interesting move in financial companies, specifically given credit card companies, Travelers. Okay, Visa, MasterCard, Capital One Financial, Discover. Okay, am I missing one? I feel like I'm missing one. Did I miss one? No, American Express. Don't forget it. Don't leave home without it. Is that, nope, is that, I can't remember. So many of them say don't leave home without it. Of course they say that. Now, let's look at our example. Let's say the investor said, James, I want to try to buy the shares. Okay, is that Capital One? I think it's Capital One. I don't know. Now, if we take a look at this, kind of gotten above some levels of easy source. Okay, now if we take a look, about right there. Now, one of the ways in which we can see the higher lows is the green dots. So if you look at recently, green dot, green dots, green dots. That is the most elementary way to see higher lows, okay? And it's just showing so far, okay? So far, history up to now is showing really higher lows. Now, what we're going to do in this example, let's say the investor said, James, I want to be bullish on this, and I want to kind of take a trade on this. Let's say the investor says, I want to do like let's look at the volatility for just a sec. Front week volatility tomorrow, 38. Drops down to 33, but still pretty decent volatility. Now, you go down and look at today's option statistics, we actually say, where is it in the range from low to high? It's at the 33rd percentile. So it's not at 80. I know, some people have regret, say, geez, I wish I would have done was 80. It's at the 33. Now, the thing you got to understand is when you have stocks that are upward trending, it's normal that the implied volatility is probably not above 50 because the upward trends tends to zap the implied volatility. Not all, okay? But a lot of times you'll actually see stocks with, 25, 30, 35 IV because the uptrend doesn't tend to have that same volatility as when the stock is going down. Now, what we're going to do is going to go to the June expiration. We're going to go to the at the money strike on the call side. We're going to right click on that 280. We're going to buy the shares. We're going to buy the call, at the 280 threshold. And we're going to sell the 290. Now, here we go. We got a couple comedians in the chat here today. Welcome. Now, we've got 280, which, by the way, I like that. Keep going. 290, 563 debit. Okay? Now, let's kind of think about something like, let's go back to the position sizing. So let's say kind of the example was, hey, go to this portfolio. Let's say the portfolio has 100,000 $100,500, and the investor says, I'm willing to risk a 0.5%. Well, that's $500. If we did an option trade, we're slightly, okay, above that level by $50. But we cannot do any more than one contract. If we risk $50 more, it's not theoretical, it's defined given the vertical, but we're tapped out in this paper trade example of $555. Again, the risk we're willing to take if someone said, I'm going to take 0.5%, 502. Here, it's 555. Dramatic? No. Life-changing? Probably not. Okay? Now, when we look at these potential max loss, potential max gain, this is given a vertical strategy. Okay? Now, also notice the commission there, and that adds to the cost of the trade because it includes the commissions. Send the order. So trade number 2, what we actually see right there is we're going to go back to that little card space and see, can Amazon get a little push? Okay. Now, the one thing I want to kind of also bring out, okay, so let me kind of show you a couple stocks, okay? When we talked about Boeing, we brought up American Express, and if you actually take a look at a stock like Disney, as I tweeted about this morning, Mickey Mouse ain't playing around. Someone's buying Mickey Mouse, okay? Now, it's not a recommendation. I'm just saying that's a pretty big gap on the stock in the last week or so. Now, the other one we kind of want to point out is Nike. Could this stock finally carving out the bottom? It has been anything but Nike Air, okay? And you're going to see that it has some levels on this. Now, I bring this up because some investors, they kind of like different types of stocks, okay? Sometimes investors like to buy stocks that might be beaten up, fundamentally and technically, and maybe coming back into favor. Could Nike be coming back into favor? It was really Nike and actually Disney that were just dragging down the Dow by themselves. And that's been the first time we've been able to get above the 59 resistance level. Keep an eye. IBM, what a horse, okay? Squirting inside that old area of that 254 threshold. Is that a recommendation? No, just showing what the price is doing now, what it has been doing. Price poking inside 254 into the old channel, with the top of the channel being 268. Most all the examples we look at today came from what index? And I want to go back to Amazon. Now, if you look at Amazon, we're going to close with this one. Amazon kind of looks like Nike, okay? Now, if you take a look at Nike, what you're now going to notice is a little diagonal support. Now, everyone say with me, diagonal. And I want you to say like diagonal, like we're from Milwaukee, okay? Now, if we take a look at this, you're going to see a little poke above the 191. Let's say the investor said, hey, James, I want to try to buy shares of the stock. Remember we talked about the 80-20 example? Let's say the investor said, I want to kind of try to have this where I'm investing for 2 to 3 weeks to maybe 2 to 3 quarters, okay? Now what the investor, let's kind of bring back up the little sheet of paper and just kind of look at the numbers for just a moment, okay? Now what's the stock price? 193.28, okay? Support level. Well, if we take the diagonal line, it's right about 185.92, okay? Now, if we said, okay, the stop, less 2% below the support level, the forecasted risk per share from there to there, $11. That's the forecasted risk per share because the stop doesn't guarantee the exact exit. Now, I'm going to show the example, could we maybe risk, could we invest more? Now, I want to kind of point this out. If the investor said, James, I'm willing to risk $500. Well, could the investor, now normally if you said, James, I want to do 5% cap, that would only be 26 shares or $288 forecasted loss. However, if they said, James, I'm willing to push this out to 8% of the portfolio value by 42 shares, that loss would still be below risking 0.5% of the portfolio. So in this example, if I can, we're going to buy 42 shares of that stock, okay? Right click, buy custom, and I'm going to go with the OCO bracket. 42 shares. Yep. 42 shares. Okay, put it right there. Data GTC right there. Data GTC. And we're going to put the stop. Where was that stop? Answer was 182.20. Okay, 182.20. And when we talk about that target price, if we go back to that chart for just a sec to close this out, you're going to see that next level resistance is going to be about 205. We're going to put that resistance, right about 205. Put it right there. Now, here's what I want you to do from today's session. I want you to go back and study what we talked about here today. Why did I talk about what I talked about? The reason why I talked about what I talked about is I think sometimes as investors, we get mentally, emotionally, psychologically turned around from technical analysis. We smear the charts based upon what we feel, what we hear, okay? And so I want you to go back and study the session, rewatch it. Stay tuned for our next webcast coming up right at the top of the hour. I want to also give you a quick reminder that if you go to this page right here, it's going to show us the webcast schedule. And that next webcast coming up right at the top of the hour is going to be Short Verticals with the Ben Watson. And also remember that you could actually join Brent in his class tomorrow on the advanced option strategies as well. So I'm out of my time. Remember with what we discussed, it was done for example, illustrative purposes only. I gave you a homework assignment. All investing involves risk, as we've touched upon many times here today. And remember that when we talk about risk, you should actually see if it's something you would consider for yourself. And also we talk about stocks and options in our examples. Now, this has been the class on Trade the Trend. Stay tuned for Ben coming up next. Take care. Bye-bye.